Hello everyone, my name's Forrest Stevens. You're listening to or watching Taking Back Crypto. Before we get into it, I want to tell you about my Geyser Fund, which is funding the formation and creation of a documentary about Bitcoin and El Salvador. The title is called The Land of Volcanos and Bitcoin, and there's a link in the description for information about it, as well as how you can help crowdfund it and make it a real. All of the funding will be done in Bitcoin and through the Lightning Network. And if you haven't used Bitcoin for transactions, if you haven't bought anything with it, and if you haven't used the Lightning Network, this is your opportunity to do that for the first time. So check it out, link in the description. And now I will talk about why FTX was actually a good thing for Bitcoin. Now that seems kind of crazy because it was a massive scam. But the thing about that scam is that it got found out. It collapsed, it exploded. And what a exchange kind of is a bank that allows its users to make investments. There are investment banks out there, Charles Schwab, and most banks have a side of them that is an investment bank. TD has TD Ameritrade. And there are many banks that allow you to invest through them. So if we think about FTX as a bank, we ask, why did they become insolvent? Because they basically created a fraud and they lent out and they used assets that were finite. Now, when a bank does this, when Bank of America, when JP Morgan, when Credit Suisse, when Silicon Valley Bank makes bad investments, there is a borrower and there is a lender of last resort. Now, who that is it's a combination of the Treasury, it's a combination of the Federal Reserve. Now, the Federal Reserve, in hand with the Treasury Department, can backstop when these banks collapse. And they do that through money printing. They do that through basically seizing and buying toxic assets. That's what TARP was, which is basically was a program that happened after the 2008 financial crisis. None of those mortgages, I mean, some of them got foreclosed and just kind of canceled, but a lot of those didn't. Those were just bad investments. It was just too low of an interest rate for too big of a house with a borrower that didn't have enough money to consistently pay. Now, if somebody offered you that as an investment and they were very direct and open about it, you would say, no, thank you. That sounds like a terrible investment. Now, what the government did was they said, yes, that is a terrible investment. We'll set up a program to buy all of these terrible investments from these banks that failed to do due diligence, or if they did, they didn't care. So how does this get back to FTX? FTX borrowed their own customers' funds. Now, they did this without acknowledging or without the consent and acknowledgement from their customers. Their customers didn't really know this was happening. When we put money, we put our cuck bucks into the bank system, there's something called fractional reserve lending. Now, where does your yield come from in a bank account? Where does your money, your interest, your savings interest come from? Wherever there's interest, there's risk. Now, there's very little risk because you're risking something that can be created out of thin air. You're risking dollars in a bank that is insured, and there's a lender of last resort called the nation's central bank, which can create more of these dollars as needed. Now, everybody suffers from the creation of those dollars because it's simple supply and demand. And if you've been in Bitcoin for any amount of time, you understand that. And that's why you hold something that cannot be inflated. You hold a hard asset. Now, FTX was offshore. It was in the Bahamas. And it had basically the same thing as fractional reserve lending. You put in $10, They probably borrowed 9 of it. And what they did was they borrowed that 9 and they gambled it. They invested it. They traded it. They messed around with markets with a sister company called Alameda Research. Turns out that they sucked at trading. They were over leveraged and they were in a bear market and they didn't hedge their bets properly. They're in what everybody realizes and understands are risky assets, which are altcoins, cryptocurrencies. Now, this podcast is called Taking Back Crypto because there's a big differentiator between crypto as we know it and Bitcoin. And I think that when we think of crypto, we should think about Bitcoin. We should not consider all of these other coins and tokens and BS, and we should focus on Bitcoin. But currently, when we think of crypto, we do not think of Bitcoin. We think of all this other mess that FTX was involved in. Now, what's interesting about all this is we have a similar story about risk and about being in a bad situation when there are withdrawals. So FTX ultimately collapsed because they made bad investments with their customers' funds. And when those customers wanted their funds back, they couldn't just create new ones. They tried kind of by creating their own token called FTT, but when that collapsed because people started to say, oh wow, 56 million or whatever CZ said he owned was going to be dumped on the open market, the price of that went down. And it turns out that's all they really had was this money they printed out of thin air. And people lost confidence in it. They lost confidence like people lost confidence in the Zimbabwe dollar or in the Venezuelan currency or so many other countless examples throughout history of fiat exploding. Let's talk about Silicon Valley Bank and how it parallels. Similarly, the customers of Silicon Valley Bank put their money in. Silicon Valley Bank took those funds and bought what they presumed were very low risk and what everyone presumes as very low risk investments. Long dated treasury bonds. Now, it would have been way smarter if they had bought short-term treasury bonds known as T-bills and just had the smaller percentage. But I guess their risk management advisor was out to lunch. I don't know the full story. Seems very stupid to me. But the thing is these investments have a lot of risk because they have a long time frame. And they're subject to the whims of Chairman Powell and his cronies at the Federal Reserve. And what do they decide to do with interest rates and what other banks decide to lend things at as well. I mean, they're all basically connected and all the same thing. They all own shares in each other. They all own shares in the Federal Reserve, which is a private entity. So these smaller banks, the bigger banks that all own each other and are all involved in the manipulation of interest rates and currency debasement, they don't care so much about the smaller guy. Now, Silicon Valley Bank was a big bank, but JP Morgan is bigger. And a big fish can eat a smaller fish. You know, HSBC basically bought out Silicon Valley Bank. It was kind of like almost like a forced sale to, stop the liquidation, to add some extra security, to reassure all the people that were involved in this bank debacle, that everything was okay. There was also a big backstop by Janet Yellen, who is the head of the Treasury, the US Treasury. And we can also look at, Credit Suisse as another example of this. UBS bought Credit Suisse out because they had terrible investments as well. Now, why didn't a bank just buy FTX out? Well, they could have. They could have. Another exchange could have. But basically, why I think FTX was a good thing is because it was a giant fraud and it exploded really quickly. And it got shown to the world that, first off, all of these speculative altcoins can really screw you over, or can screw over a company, and that not having proper risk management can screw you over, and you should be thinking about these personally, how this relates to you in your personal life. We all need to think like a company does with our finances. Although they may be much smaller in scale than a company, we can apply the exact same principles. There are some things that are private, hidden, behind the scenes, purposefully veiled in what FTX was doing. But there were certain aspects that weren't. And that's because of the money that they were dealing with. They're dealing with Bitcoin, which has a fixed supply, cannot be debased. Its issuance is fixed as well. And similarly, a lot of other altcoins have copied this. And basically, all the ones that these companies are holding, like FTX, they've also copied the public ledger system. There are a few privacy coins out there, but oftentimes those are just hot potatoes. People love Monero. There's a big Monero company or community out there, but it's not a store of value because you don't actually know what's going on with its issuance, with its who owns it, what, it's a big black box, and sometimes you need a black box to transact with, but there are ways to transact privately in Bitcoin as well and settle ultimately on the Bitcoin base layer, which is public. So what I'm saying here is FTX loved coins like Solana. They loved coins like FTT. And they probably loved a bunch of other scammy vaporware coins that were easily manipulated. Just as big banks love the dollar because it is easily manipulated and they're the ones that are in there manipulating it. So why I think FTX was good for crypto was because it exploded. It blew up, it collapsed. And it is dissimilar to what happens with banks. They do not blow up, they do not collapse, but they are doing the same exact scammy thing. They are using their customers' funds to make money from. A big pile of money can accrue more money quickly. And they're doing that with terms like fractional reserve lending. And, their lending requirements are ridiculous, crazy. And these scams, these banks, they rarely blow up. I think it was Lehman Brothers. I can't remember if it was Lehman Brothers or Bear Stearns. One of them basically got backstopped, the other one didn't. The one that didn't never thought it wasn't going to. It continued buying these distressed assets thinking, well, eventually it's going to go back up. They were so underwater, they thought, well, yeah, okay, well, eventually they'll go up and the Fed will just bail us out. And they didn't get bailed out. But the next one did. And the next one after that did as well. And Silicon Valley Bank got bailed out. And Credit Suisse got bailed out. And all of us as currency holders, as citizens in the global world that uses these terrible currencies, we all paid for that bailout through inflation. And inflation is a hidden tax because it debases all the other currency you hold and all the other dollars you hold. So get yourself, basically, in my opinion, I have gotten myself onto a Bitcoin standard that is a hard asset, fixed supply, fixed max supply, and fixed issuance, completely decentralized, permissionless. To me, it's absolutely ridiculous when people say that Bitcoin has no use. There's one of the heads of the Federal Reserve, I think his name is Kashkari. He said Bitcoin doesn't have a use. It's sound money. It's money you can save. It's permissionless money. It's money that has a max supply and a max issuance. These are all incredibly useful things when other money does not. The other money that we use does not. So I will continue to hold Bitcoin. I will continue to talk about Bitcoin. And I will continue to advocate for Bitcoin. Bitcoin, not crypto, until crypto doesn't really exist anymore and we take it back and Bitcoin and crypto are one. But until then, there are 40,000 plus other cryptocurrencies that all go to zero against Bitcoin.